If I show you this chart, can you tell which time frame I'm using? No. If you view a chart on a 1 minute, hourly or daily time frame, you wouldn't be able to distinguish one from the other. That is because the price action on the charts have fractal characteristics. We can see similar patterns at various time frequencies. This is a very important topic in trading, and today you'll learn how to correctly trade market fractals. So if you could, like, subscribe to the channel, and stick around for the full video. At the very core, a market fractal is the basic building block of price movements up and down. Fractals indicate market turning points or swing points. Every support or resistance formed in your charts first start with a fractal. You can see why fractals are one of the best tools, especially when trading price action. In any trading decision, it's critical to find support and resistance areas, whatever time frame we are looking at. Fractals were introduced by Bill Williams in his book Trading Chaos. Fractals are centered on the idea that there is repetition in price behavior, and they can provide an insight into the repetition patterns. The indicator usually looks like a 5 bars model, which is aimed to identify possible reversal points and detect the direction of price. In order to find the fractal formation, you must look at 5 successive price bars, where the third or the middle one represents the highest high or the lowest low. In an up fractal, the middle bar will have a higher high than both of the bars at either side of it. In a down fractal, the middle bar will have a lower low than both of the bars at either side of it. Keep in mind that the fractal arrow appears only above or below the third candlestick if it is the highest or the lowest of the 5 bars. A bearish fractal pattern, which indicates a market reversal to the downside, forms when each of 3 successive candlesticks show price recording a higher high, followed by 2 candlesticks showing price action with a lower high than the high of the preceding candlestick. Bearish fractal pattern serves as a resistance. A bullish fractal pattern, which indicates a market reversal to the upside, forms when each of 3 successive candlesticks show price moving to a lower low, followed by 2 candlesticks showing price action with a higher low than the low of the preceding candlestick. This fractal acts as a support level. Fractals provide more reliable signals on higher time frames, but it will also display fewer signals. Obviously, depending on what time frame you're using, the absolute amount of time required to form a fractal pattern varies. If you're using the hourly chart, a fractal pattern can form in 5 hours. If you trade the daily chart, you will see fractal patterns that form over the course of 5 days. One of the advantages of fractal pattern is that it's relatively easy to spot on a chart. Notice here how the middle bar within the up fractal has the highest high of the entire 5 bar structure, and how each of the 2 bars preceding it and following it have a lower high. This creates a level of resistance in the market, and the expectation is for price to continue lower until the next down fractal forms in the market. When you look at the middle bar within a down fractal, you can see that this has the lowest low of the entire 5 bar structure, and that each of the 2 bars immediately before and after it have a higher low. This creates a level of support in the market and an expectation for price to move higher until the next up fractal forms in the price action. The structure of the market fractals is very simple to understand. You can build many different trading rules and models around the concept of fractals. But very important, the 5th candle in a fractal pattern must close before you make trading decisions. This is because the price can move during the time the 5th candle is forming. If price moves either above the higher high or below the lower low while the pattern is still forming, the fractal indicator will disappear from your price chart. So you must wait for the pattern to complete in order to make sure that the fractal is confirmed. The fractal pattern reveals a V or a U-shaped bottom or top. Such a pattern of price action may indicate a market reversal, either a previous uptrending market gradually turning over to the downside or a previous downtrending market turning to the upside. At a minimum, a fractal pattern is useful for identifying at least a temporary level of price support with a bullish fractal or price resistance with a bearish fractal. So you can use fractals to determine the possible direction of price. One way in which you could do this is by looking for broken fractals. A fractal is considered broken when it has been confirmed and then the price breaks through either the high or the low of the pattern. If the price breaks an up fractal, then the direction of the market is considered up. And if the price breaks a down fractal, then the market is considered down. But this isn't enough. On their own, fractals will offer many false signals. As a standalone price action tool, fractals are quite unreliable. The main problem with fractals is that there are so many of them. Therefore, to get the best out of them, you must filter the signals with some other indicators or forms of analysis. You must view a fractal pattern in relation to other confluence factors, such as support and resistance levels, supply and demand areas, pivot points, Fibonacci levels, or round numbers, in order to evaluate the strength of the fractal. For example, if the high point of a bearish fractal coincides with a supply area that also identifies the price point as a potential resistance level, then the fractal pattern is more reliable and more likely to be an accurate indicator of a market reversal. Fractals can help assessing the potential direction of a price move. For example, if a down fractal has recently printed on the price chart and the overall trend is higher, then we can expect price to continue higher. Along the same lines, if an up fractal has recently been breached by a new price leg that is moving higher, that upside breakout can indicate that the price momentum may continue higher. So if the market is in a strong uptrend, there will be more fractals that are broken to the upside than the downside. That being said, the inability to break through the previous fractal can give you a hint that the market is getting ready to consolidate or perhaps even change trends. The question then is whether or not the market is going to turn around and break through the opposite direction fractal, because at that point, the previous trend could be rolling over and changing. Another way to use fractals is with a moving average or with anchored VWAP. I've talked about the power of this indicator in this video. Adding a dynamic level of support and resistance allows you to stay on the right side of the trend. For example, if you get a fractal that forms in the other direction of the trend, you simply ignore it, at least until the moving average or the VWAP tell you it's time to go in that direction as well. If you have a 50-period exponential moving average that is moving to the upside, then you are looking for up fractals being broken, as you not only have the fractal indicator pointing in that direction, but you have the longer-term traders supporting the move as well. Or, if a down fractal appears and is located near the moving average, then you can treat the previous move as a pullback, with price founding support in an uptrend near a moving average. 3 confluence factors that signal that the price is more likely to continue higher. Fractals can also be used during the trade management process. We know that an up fractal can serve as a resistance during a rising market, and that a down fractal can serve as a support during a declining market. As such, you can use these important levels for the placement of stop loss and take profit orders. When multiple fractals appear around the same area, let's say a resistance area, you can set your stop loss level when entering a short position above the highest fractal. Make sure you don't place it right above or below a fractal, so leave a bigger margin in case there's some sort of liquidity hunt. Taking profits could also involve the use of fractals. For example, if going long on a fractal, you could exit the position once a price hits a bearish fractal. I heard some traders close their positions when an opposite fractal appears, but this is a very bad money management approach, because the fractal signal will lag by a couple of bars. At least 2 closed bars are needed for a fractal to be completed, meaning that when it provides a signal, the price may be at another level compared to the signal, so don't rely on this approach to take profits. Fractals are excellent for visualizing major highs and lows and act as a support and resistance level. A better approach to take profits is a few points above or below a previous fractal. It's best to plot fractals in multiple timeframes. For example, trade short-term fractals in the direction of the long-term ones, and focus on long signals during larger uptrends and on short signals during larger downtrends. In day trading setups, for example, you could base your trades on support and resistance areas offered by fractals on the 4-hour and the daily charts. You can check the 30 minutes or the hourly time frame to look for entries, but you'll use fractal periods on the higher time frames to spot support and resistance areas. In this example, you look for reactions at this resistance level given by the fractals on the 4-hour and the daily time frame, and trade on the 30 minutes time frame. Trading in a lower time frame lets you to read price action while watching important support and resistance levels on higher time frames. If price breaks this major resistance here, it can be a potential breakout setup. If it rejects the resistance, it can be a decent reversal setup. This price action approach might not be suited for beginner traders, but if you are an experienced trader, fractals could be of great help, perfect for finding areas of value on your chart. Look for areas where multiple fractals form and mark those areas. If multiple fractals form around a certain level and price is unable to go through, that zone is an important one. Now let's be clear, fractals don't predict the price. They offer lagging signals. The arrows for the pattern are typically drawn over the high or low point, which is the middle of the fractal, not where the fractal completes. Therefore, the arrows can be visually deceiving, so be careful, since the pattern is actually completing 2 bars to the right of the arrow. The first available entry point after seeing an arrow is the opening price of the 3rd bar to the right of the arrow. I wouldn't base my entries on the appearance of a single fractal. Fractals have practical meaning only as a part of a comprehensive strategy and only for periods of more than 1 hour. Another disadvantage of trading fractals is the fact that they occur quite frequently in the ordinary course of price action movement. Therefore, the pattern is prone to giving many false signals. That's why few traders rely only on the fractal indicator for trading signals. Instead, they are using it in conjunction with other technical indicators. And remember, the longer the time period on the chart, the more reliable the pattern. So look for fractals on the hourly, 4-hour, and the daily timeframes. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.